So now we're going to look at another type of adjusting entry. And this one is for long-term assets. So first of all, I want to start by explaining what I mean by long-term assets. So long-term assets are assets that, number one, have physical substance, right? Meaning you can touch them, they're tangible. And number two, they have a future benefit of more than 1 year. Okay, so examples of that are things like buildings, vehicles, machinery or equipment, computers, furniture, anything like that that a company is going to use for more than 1 year. And these are actually a type of prepaid expense. Because again, if you think about it, you have to first buy that asset, whatever, that computer or that vehicle, and then you use it later over time. So I find sometimes that students kind of get confused between when we use the term supplies and when we use the term equipment, because they sound similar, right? So supplies, again, are anything that is used within 1 year, okay? They're more short term in nature. So we're looking at, for the shampoo example that I gave you before in the previous video, or any kind of office supplies, right? Paper, pens, pencils, all that stuff is going to get used within a year, okay? Now that's different than equipment, right? Equipment is going to be used for more than 1 year, okay? Again, we're talking about machinery, computer, things like that are going to be used for more than 1 year. So that's why these are considered long-term assets, okay? Long-term or long-lived assets. Another key difference is that supplies are things you can't really use again, right? So for example, you use shampoo, it's turned into suds and gone down the drain, it's gone, right? Or paper, right? Once you've used a piece of paper, you can't really use it again, right? It doesn't ever become a clean sheet of paper again, okay? Now that's different than equipment, right? Equipment is something that you have continued use. You can use it and it pretty much looks the same over the life of the asset. So this piece of machinery, as you use it, it doesn't change form. I mean, I guess it changes a little bit. It might have some dings or scrapes, but it doesn't change as much as, shampoo or a piece of paper, right? Same thing with the computer. Yeah, I know your computer might get dinged up or perform a little slower, but essentially your computer is going to look the same the entire amount of the time that you use it. So that's another key difference between supplies versus equipment. Okay, sometimes it can sound similar to us, but in accounting, we account for them very differently. Okay. So here's the thing with long-term assets, they don't change significantly over time, but they do change. Okay, so it's not as obvious as the shampoo. When you use it, it physically changes and like disintegrates and goes down the drain. Trucks and buildings and machinery, it doesn't really work that way, but there is a change, right? We see that this here is a brand new truck, versus this one's got some scrapes and some rust and things like that, right? It's not in as good a shape. Okay. And why is it not in as good a shape? Because it's been used, right? We've been using for year after year after year. Okay, here's the thing. Long-term assets don't last forever. They last a long time, a lot longer than other things, but they don't last forever. The future benefit is limited. Okay, we buy a truck, there's future benefit there, but it's not indefinite future benefit. It's gonna end at some point in time. So what we do in accounting is we kind of refer to that as the asset's estimated useful life, meaning how long can I use this asset? And it's going to be different for different types of assets, right? If you're talking something like a computer, computers might be used, have a useful life before they become like obsolete for like, I don't know, 3 to 5 years, something like that, versus, a truck might be something more like 5 to 7 years, or a building, right? A building might be used for, 15 to 30 years. Okay. But the point is that it's not indefinite. There's a finite amount of time that you can use these things. And that's referred to as the estimated useful life. So I'm going to be teaching you a lot of different terms. You're going to learn some new words and terminology now. And these terms are actually going to come up again when we revisit the concept of long-term assets in chapter 8. So pay attention to the vocabulary, to the terminology, because we're going to be using this in the future. All right. So let's look at an example of a long-term asset. Let's say, for example, this truck, right? So we're going to say the company purchased a delivery truck for $60,000 to use over 6 years. So if you're looking at a timeline of this truck, we see that we paid for the truck at the beginning of its life, and then we use the truck over the next 6 years, right? So the 6 years is the estimated useful life of this truck. So what happens is that, let's say now it's right here, it says the company uses the truck during the first year, right? That's why we bought it, was to use it. So now we're kind of at this point in time. We're a year into the life of this truck. And two things have happened. Okay. One, we used the truck, right? And so we need to account for the fact that we used the truck. And second, what do you notice has happened at this point to the estimated useful life of the truck? How much more usefulness are we going to get? Right? We started out with 6 years of usefulness, but now 1 year has gone away. So that means there's only 5 years of usefulness left. So we have to also show our future benefit decreasing. Okay. So we have to record those two things. We have to record, one, that the truck was used, and two, that the future benefit has decreased because that truck isn't going to last forever. So if you do your REAL analysis, right, what we're doing here is we're going to record the expense or usage of the asset, and we're going to record the future benefit decreasing, or the asset going down. So that's what we have to include in our adjusting entry. So again, this is like all the other prepaid expenses, right? We're going to debit expense, right? We're going to debit expense because expense is always debit. And we're going to credit asset because a credit to an asset account always means that asset is going down, right? The future benefit is going down. But the question is, what accounts do we use? Well, when it comes to long-term assets, these assets are unique, and we treat them uniquely with unique account names. Okay, so these are account names that we have not used before. Okay. The account name that we use is depreciation. Okay, depreciation. Now, you may have heard that term before. Whatever you think it means, wipe that definition out of your head. I'm going to teach you a new definition, Do not use your old definition. I have students who do this all the time and they end up tripping themselves up because they don't want to use my definition. Please use my definition. I'm teaching you the definition we use in accounting. In accounting, the term depreciation means allocating the cost of a long-term asset to expense as it is used. Okay? So what that means is this, okay? The cost of our long-term asset in this case is the $60,000 we paid for it. Okay? And we're going to use it for 6 years. So that means we need to take the $60,000 and allocate it or spread it out over each of the 6 years that we use it. Okay, we have to take the 60,000 and as the asset is being used, we're going to allocate that cost. We're going to spread the $60,000 to expense over time. Okay, that's what depreciation is. So the account names that we use, and again, don't worry about the dollar amount, okay? Because I have students concerned about that. The 60,000. Well, how much do I allocate to each year, right? There are different methods for how to come up with the dollar amount. I'm going to teach you that in chapter 8. Don't worry about it for now. For now, that amount will be given to you in the problem, okay? So don't worry about the dollar amount. I will say, for example, in year 1, depreciation, or we used 15,000 of the truck. Okay. So I'll tell you how much. You don't have to worry about calculating the amount. Instead, what I want you to focus on is understanding the terms, right? Understanding what depreciation means. And understanding just the terms, the concepts, and the accounts to use, okay? So the account name we use is called depreciation expense, okay? Depreciation expense is the cost of using your long-term asset. I say LTA, that stands for long-term asset. So the cost of using your long-term asset. Again, that term use goes with the term expense. Okay? The cost of using your long-term asset. So we don't call it truck expense. We don't call it equipment expense. We call it depreciation expense. It has a unique name, and that name is the name we use for any long-term asset, using a long-term asset. Okay? Now, how do we show the other side of the entry, right? The other side of the entry is the asset going down. We have to show the future benefit going down. Okay, well, how do we do that? Well, again, I told you guys, it's not like supplies, right? Supplies, you can't use them again. So your supplies account, we learned in the last video, with your supplies account, we literally, right? We record supplies expense and supplies, right? That's your debit and that's your credit. We literally show the supplies account going down, okay? Because, yeah, it literally goes away, right? The shampoo goes away, the paper goes away, it becomes unusable. But remember, equipment has continued use. So we don't want to show the truck going away or the computer going away. So we're not going to decrease the truck account or the computer account. No. Instead, we use a completely different account, and that account is called accumulated depreciation. Okay, accumulated depreciation. Okay, now accumulated depreciation is a unique type of account. It's an account we call a contra asset. Now, the word contra kind of, you think about like that, when your teacher tells you to compare and contrast, right? Contrast is to find differences or opposites, right? So a contra account is like an opposite, right? An opposite. Or you could even say, but the term I like to use is against. Okay? Against. So it's an account that goes against the asset, but it's a separate account. Okay? So we don't use truck. We use a separate account called accumulated depreciation. Okay? And this account represents the portion of the asset that has been used, right? So whatever part has been used that the future benefit has gone away, we put it in that account. And it represents a decrease in the future benefit. So let me show you what that looks like. Okay. All right, so you're going to use, so the other side of your entry, you have depreciation expense. That's, again, using the asset. And then you have accumulated depreciation, which is the future benefit decreasing, right? Because it's a credit, but it's in a separate account. Now, what does this look like visually? If you're looking at the ledgers, it goes like this, okay? You've got your truck account, right? Remember, we originally paid $60,000 for this truck, okay? Now, the rule for long-term assets is they are always held at their original cost, meaning whatever we paid for them. We don't touch that original cost until it's time to sell the asset. Don't worry about that now. We'll talk about that in chapter 8. But the point is, we do not touch the long-term asset account, in this case, truck. We don't touch it. Why? Because the truck did not go away. The truck is still there. So we leave that account alone. Instead, what we do to show that the future benefit of the truck is going down is we put it into this contra asset account, this account that goes against the asset, and that represents the decrease in the future benefit. So you see here, if we were to say the first year we used up 10,000 of the truck, you see there is your credit to the accumulated depreciation account, right? So we've got the debits held in the truck account and the credits held in the accumulated depreciation account. But if you put those two together, right, the debits on this side and the credits on this side, and you put them together, I call them net, right? There's that term net again. Net is when you're offsetting positives and negatives, right? So you've got the positive debit on this side and the negative credit on this side. So when you net the two, you get 50,000. Right? The 60,000 minus the 10,000, you get 50,000. Now this amount, the term we use for that is book value. Book value, okay? So the formula for book value, again, is the asset cost, right? Which we see here in the asset account, minus accumulated depreciation, which you see here in that account. And this book value account represents the remaining future benefit, or the unused portion of the asset, right? So if accumulated depreciation represents the portion that was used, right? Then this 50,000 must be the unused portion, the portion we haven't used yet. Therefore, there's still that future benefit of those future years. Now, when it comes to year 2, right now, let's say we're at the end of year 2. Well, now 2 years have been used up, okay? So in year 2, what we're going to do is we're going to record another adjusting entry to show that we used the asset for another year, and therefore the future benefit has gone down more, right? Now we only have 4 years left. So what does that look like? Well, that's where you might understand now why we call it accumulated depreciation, right? Accumulate means to gather, to add up, okay? So this is where we add up all of the asset that has been used, right? So in year 1, we used 10,000. Then in year 2, we used another 10,000. So now the total in our accumulated depreciation account is 20,000, right? That represents 2 years that have been used up, okay? So now if you were trying to calculate the book value, meaning how much remaining future benefit we have, how much of that truck has been unused, how much are you going to get? Well, 60,000 minus 20,000, right? That's your book value, asset cost minus accumulated depreciation. You're going to get 40,000. Okay, that's your book value. Okay. So now the question is, if the book value at the end of year 2 is 40,000, does that mean I can sell the truck for 40,000? What do you guys think? Well, the answer is no. No, 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 no. Okay. This is where I want you guys to understand the purpose of depreciation is not to tell you how much you can sell the asset for. That does not factor into it at all. Okay. Depreciation is not meant to be a valuation. In other words, to value how much you can sell it for. No, again, let me explain. Depreciation is allocating the cost of a long-term asset to expense as it is used and to record the decrease in the future benefit because it can't be used forever. But it is not meant to tell you how much you can sell it for. So please, I know some people come into this class with a preconceived notion of what depreciation means. Depreciation means, oh, it's going on down in value. It means I sell it for less than I bought it for. That's not what we're trying to do. Yes, I know that happens, that as you use it, it's going to be worth less. So you're going to sell it for less than you bought it for. I get that, but that is not how we come up with the number. That's not how we come up with the dollar amount for depreciation. Okay, that's not going to tell you how much you can sell it for. All it tells you is that you've used the asset and the future benefit has decreased. Okay, that's all it tells you. And future benefit meaning number of years. Okay, number of years that you can use it has gone down, right? Because you thought you could use it for 6 years. Now 5 years, and then 4 years, and then 3 years. That's what the purpose of depreciation is. Okay. So I know I threw a lot of new terminology at you. I hope that this will help you make sense of everything so you can watch this video and get a good handle on these terms. Like I said, we're going to be revisiting them again in chapter 8. You're going to be revisiting them again in accounting 1B. So please take some time to really understand these concepts. It will be in your best interest down the line. And if you have any questions, of course, please let me know. Thanks so much.